Hi everybody, my name is Griffin Bridgers. Today it's my pleasure to bring a presentation on a recent private letter ruling in the world of GST tax, which has some valuable insight, although the facts and procedure are fairly basic. But nonetheless, there are some valuable takeaways for anybody who prepares estate tax returns. Now, before we get to the substance of the presentation, I just want to mention this is one of the first videos where I've showed up on camera. So I plan to use this talking head format for the bulk of my videos in the future. So obviously the posting frequency will be reduced a little bit, but this is the way I want to introduce topics in the future and present material to you, as it produces a better connection to you, the viewer, and I feel like it creates a more meaningful presentation as well. But let's jump back into the presentation. So specifically, we're covering Private Letter Ruling 2022-10011. So what was involved here? Well, the facts were pretty common. We had a decedent who during life had created a revocable trust, and in that revocable trust, there were trusts to be created at the decedent's death for the decedent's children. Now, as with any revocable trust instrument, it called for these trusts to be set up that would become irrevocable. Now, the decedent had no grandchildren living at the time of death, only children in that first generation. However, nonetheless, there was a funding formula within the decedent's revocable trust that said, at my death, take my remaining GST tax exemption and allocate that amount of property to these specific trusts, which I intend to be exempt from the GST tax. And anything left over, I want you to allocate to these other specific trusts, which I intend not to be exempt from the GST tax. So that's where the problem came in, because the facts of this private letter ruling mentioned that a Form 706, an estate tax return, was required to be filed and was timely filed. However, the tax preparer neglected to fill out Schedule R of the Form 706. Now, what is Schedule R? Well, it's the schedule upon which you actually allocate GST tax exemption to transfers made in the estate plan, whether outright or in trust. Now, some of you may be wondering why this is a big deal, especially if you're familiar with the GST exemption automatic allocation rules. Well, what I want to mention here, and the key lesson in today's presentation, is that the automatic allocation rules work differently upon death than they do during life, because it's rare during life that you actually make gifts that exceed your remaining GST tax exemption. Typically, you still have some exemption left over at death. However, it's common at death to have transfers that exceed your remaining GST tax exemption. And that's exactly what the decedent's revocable trust and estate plan contemplated here, is that the total value of his estate and transfers to these trusts for children would exceed the remaining GST tax exemption. So it was folly to rely on automatic allocation, which is what kicks in when you omit that Schedule R from Form 706. Now, the cost to doing so is found in the Internal Revenue Code, which specifies that at death, you have to allocate the remaining GST tax exemption equally among 3 pools and trusts within each of these pools. And there's no allocation among pools. It's really taking trusts in each pool and automatically allocating the GST tax exemption ratably amongst all of those trusts. The pools are 1, any trusts that are set up at the decedent's death; 2, any trusts that are set up by the decedent during life are nonetheless included in the decedent's gross estate; and 3, any trusts set up during the decedent's life which are not exempt from the GST tax. So we don't know if any of those other trusts existed, but nonetheless, there's this risk here and this outcome that the decedent's remaining GST tax exemption got spread out amongst the trusts that were intended to be GST exempt and the trusts that were intended to be GST non-exempt. So that was an error, and what happened is that the personal representative of the decedent's estate had to go back, get permission from the IRS to make a late corrective GST tax allocation, which luckily the IRS granted that permission so that the GST exemption could be allocated solely to those children's trusts that were intended to be GST exempt, and no GST tax exemption could be allocated to those children's trusts that were intended to be GST tax non-exempt. So our key takeaways today are: 1, if Form 706 is required to be filed, in other words, if the estate is required to file an estate tax return, always make sure you fill out Schedule R to make sure that the automatic allocation rules don't cause an inadvertent outcome, especially based on the funding formula contemplated within the estate plan and other trusts that are set up during life, which may not be exempt from GST tax. The second key takeaway is that even if no estate tax is payable, and even if no estate tax return is required to be filed, it may still be a good idea to go ahead and complete Form 706 to manually allocate GST tax exemption to make sure that it conforms to what's contemplated in the decedent's estate plan. Thank you for joining me for today's presentation. As always, if you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com, with the caveat that I cannot give tax or legal advice in response to your questions. And I hope you enjoyed this new talking head format. I look forward to presenting to you in this format in the future. And thanks again for joining me today. I look forward to seeing you in my future content.